Meanwhile, my first guest says that the Santa Claus rally is real. I want to bring in Bank of America Merrill Lynch Director, Chief Equity Technical Strategist, Stephen Suttmeier. Stephen, welcome back to the show. The Santa Claus rally is real. Okay, we got you on there. By the way, you know I love your work. Let's talk about some of this. You're talking seasonality right now, being a position. You say December is generally the best month of the year.
In terms of the percentage of time up, it's the month of the year most likely to be up. It has a solid average return, around 1.3%.
This is 74% of the time?
74% of the time. And it's higher than any other month in terms of the hit rate.
Right. So you have a couple other months that may often be higher, but again, 60%, 61%, 74% of the time, and we've got momentum going into it this time.
Momentum confirmed by market breadth, market volume, confirmed by credit markets, confirmed by improving financial conditions. So the market has a nice, positive technical backdrop.
All right, let's go here. I want to go a little further. So you've got, this is one of your recent charts, the put-call ratio for the audience. Essentially, when investors are buying very few puts and all calls, it's a contrarian thing, right? I mean, it suggests that too much optimism is out there. That's sort of happening right now. Very little put buying, a lot of call buying. At what point does this make you worried?
I think what we're having here now is actually confirmation from this indicator because it keeps moving lower as the market's moving higher. So there is some confidence in the market. But when does it get too much? When you get back down to where it was in 2021. So we're looking at the 5-day put-call ratio here, and there's a bit more room to run on that. And even when it gets down there, I mean, it got down there in early 2021. Mid-2021, and the market didn't peak out until well after that.
Right.
So, that just gives you like a condition.
So we hit this line. I mean, it's not an instant sell signal.
No, it just tells you the condition is there. We just got to wait and see if any other indicators like credit markets or anything else deteriorates, and if it does, then that will have more meaning.
Is this what you do with most of your work? You have a central, let's say, metric you're looking at, but you also want to get confirmation from other areas?
It's a mosaic model, yes. So it's market breadth, volume, sentiment, seasonality. Yep.
I want to ask you about FINRA, margin debt.
Yep.
You had a great chart somewhere out there, a little bit too complicated. So I simplified it. Just two things we got here, folks. All you got to do, this red line is the stock market, looking pretty good. The other part, these blue lines straight up and down, these are the margins, right? How much people borrow to buy more stock. And you can see it peaked out here in 2021. Right. So we've got a ways to go there as well.
Yes, and in fact, we hit $118 billion in margin debt, and that was a high for the cycle off the 2022 low. So that confirms the cycle off the 2022 low for the S&P. So we get worried when margin debt peaks out in advance of the market. Some would say that peak in 2021 would be a warning, but right. Interest rates were here versus here now. So holding cash is a lot more attractive than taking on margin debt. So I think that's the reason why we're not at new highs on margin debt.
Stephen, would the margin debt have to match their double top thing here, or because the market is so much higher, could we actually see margin debt get higher as well, ultimately?
I mean, ultimately that is a possibility if this rally continues. We still think it's mid-cycle. Cyclical bull, mid-cycle, secular bull. So we still like where we are in the equity market. Plenty of confirmation.
I mean, there's a lot of smart people out there saying there's a lot of things you can use to say, hey, it's too much, too fast, too soon. How do you push back against that?
I don't get worried about the market until you start to see some crumbling under the surface. And you can get like a 3 to 5% pullback and then expansion in new 52-week lows. That is not happening. We had new 52-week highs confirm the rally. And normally the market tops out when that is not occurring.
I love what you just said. And this is what I'm trying to tell the audience. Hey, ride the wave. Don't assume that it's stopping because of some whatever. I can't let you go without asking about small caps. This is the Russell 2000. Now, this is a long-term chart. I see a lot of charters use this sort of thing with the breakout, that sort of thing. I saw your chart. You found some support here.
Right.
And so what's really amazing is that even though we've made this move, we're getting at now the official buy signal where we can chase this.
I think so. I mean, small caps, we don't know whether they're going to beat large or not, but on an absolute basis, you should get a rally out of that. What's interesting about the Russell 2000 IWM, which you're showing here, is the last 4 out of the last 5 presidential elections saw the Russell 2000 break out to new highs. And we probed to a new high just last week on IWM. So I do think higher highs are coming for the Russell. It could very well be a bigger base as you drew on that chart. So this looks like the S&P did about a year ago when it was breaking out.
I got you. And we wish we were in it then. We're glad we're in it now. And glad to have you. You're one of my favorites. You're fantastic. Thanks a lot, Stephen.
Thank you, Charles.
Appreciate it.
Yep.